Imagine trying to test a machine that processes 100 billion calculations every single second.
Right.
If you make even one microscopic mistake in how you feed it electricity, the entire piece of silicon literally, physically melts in front of you.
Just poof, gone. Tens of thousands of dollars, up in smoke.
Exactly. So today, we are not looking at the companies designing those impossible chips. We are looking at the company that builds the machines required to test those machines. Because, if you've been trying to figure out how to play the infrastructure side of this whole AI market and you're just sitting there staring at your brokerage account, wondering if you should buy into the hardware layer, well, this is exactly where you need to be.
For sure, because Teradyne is sitting at the absolute epicenter of, frankly, the most violently shifting supply chain we've seen since, the invention of the internet.
Yeah.
They trade under the ticker symbol TER.
Yeah.
And they just released their fourth quarter and full year 2025 earnings report. And honestly, the entire document reads like a completely different company than it was just 24 months ago.
Which is exactly why we are pulling it apart today on this Talk Tickers Deep Dive. Because as retail investors, you get handed these dense corporate transcripts filled with acronyms and non-GAAP reconciliations and executive speak that feels intentionally designed to make you fall asleep.
Oh, yeah. It's like reading a foreign language sometimes.
Right. So our mission today is to just cut through all of that Wall Street jargon. We are going to extract the hard data, figure out the underlying physics of what they're actually doing, and give you a highly opinionated, actionable take on what this means for your portfolio.
I love it.
We are going to start with the headline numbers, which are, frankly, completely ridiculous. Then figure out the engineering story driving those numbers, rip apart management's highly unusual future guidance, and give you a final verdict on whether this stock is a buy, hold, or sell. Okay, let's unpack this.
Let's do it. Because the numbers coming out of this Q4 report demand an immediate, total recalibration of how anyone looks at this stuff.
Yeah.
I mean, we were talking about fourth quarter sales of $1.83 billion.
Wait, let's just pause on that. $1.83 billion in a single quarter.
A quarter, yeah.
Wow. Because I was looking at their historical charts before we started recording, and that represents a 41% sequential jump from the third quarter.
Yep.
It made Q4 the highest revenue quarter of the entire year. And it was, I think, only $3 million shy of their all-time absolute peak record, which was set during that massive pandemic smartphone boom back in 2021.
Right. And you have to remember, scaling a highly complex physical supply chain by 41% in just 90 days is a logistical nightmare.
I can't even imagine.
It requires running factories at just a blisteringly high velocity.
Right.
But, the bottom line profitability is where the story actually gets serious. They reported non-GAAP earnings per share, or EPS, of $1.80. That is more than 100% earnings growth rate.
Real quick, just for anyone who glazes over when they hear non-GAAP, GAAP just stands for Generally Accepted Accounting Principles. It's the standard accounting rule book.
Right, the standard rules.
Right. So non-GAAP just means the company stripped out certain things they consider one-time expenses or non-cash charges. Usually it's stock-based compensation for their executives. And they do that to give you a clearer picture of their everyday operating cash flow.
Which is a vital distinction to make, because when we look at those non-GAAP numbers, Teradyne didn't just beat Wall Street estimates. They completely blew past the absolute highest end of their own internal guidance.
Seriously?
Yeah. I mean, their non-GAAP gross margins sat at an incredibly healthy 57.2%. Their operating profit roughly doubled to $314 million.
Wow.
Which yields a 29% operating profit margin. And they generated $219 million in pure free cash flow.
That's huge. And what did they do with that cash?
Well, they immediately took $204 million of it and returned it to shareholders through stock buybacks and dividends.
Okay, so wait. They took basically 174% of their free cash flow for the entire year and just handed it back to the market.
Basically, yeah.
That tells me management isn't hoarding cash out of terror for the future, right? They are aggressively buying up their own stock because they think it's cheap.
Exactly.
But before we declare this the greatest quarter in human history, I have to point out something really weird about the timing of these numbers. Because Q4 is traditionally a sleepy quarter for a company like this, isn't it?
It is the sleepiest quarter. I mean, to understand why this $1.83 billion figure is breaking the brains of analysts right now, you have to look at the historical calendar of the semiconductor testing industry.
Okay.
Because for the last 15 years, Teradyne has been heavily chained to the consumer electronics cycle, mostly smartphones.
Right. I buy a new phone in October, which means the chips had to be tested back in the summer.
Precisely. The phone release cycle dictates everything. The chip makers, they scramble to test all their silicon in the second and third quarters so the finished phones can sit on retail shelves for the holiday shopping season.
All right, the Black Friday rush.
Exactly. So by the time the fourth quarter actually rolls around, the testing companies are usually in a period of digestion. They are cleaning up, doing maintenance, and experiencing a big lull in sales.
Yeah, that makes sense.
But what's fascinating here is that by having Q4 suddenly become the largest quarter of the year, Teradyne is loudly signaling that they have completely unplugged from the smartphone calendar.
Okay, so they unplugged from smartphones and they obviously plugged into data centers. But, as an investor, my immediate instinct when I see a 41% revenue jump in a historically dead quarter is just deep suspicion.
Sure.
I look at that $1.83 billion and I wonder, is this just a temporary sugar high? They're selling pickaxes in a gold rush, but did a few massive cloud providers just panic buy a bunch of servers and artificially inflate this one quarter? Or are we looking at a permanent structural elevation of Teradyne's baseline business?
See, that is the multi-billion-dollar question, isn't it?
Right.
Because if it's a panic buying sugar high, you hit the sell button on your brokerage app today and you take your profits.
Yeah.
But if it's a permanent elevation, you hold on for dear life.
Yeah.
So to answer that, we have to look past the spreadsheet and examine the actual silicon.
Which takes us to the story behind these numbers. Because like you said, you don't accidentally tie a 2021 all-time record in an off-season quarter. The earnings transcript kept hammering away at this idea of a pivot. So just how fast is this transition happening internally?
The speed is honestly what stands out to most. Look at the timeline CEO Greg Smith laid out. In the third quarter of 2025, artificial intelligence applications drove between 40 and 50% of Teradyne's total revenue.
Okay.
By the fourth quarter, so a mere 90 days later, AI was driving over 60%.
Wow. In one quarter?
In one quarter. And as they project into the first quarter of 2026, they expect AI to push past 70% of their total business.
It's literally eating the entire company from the inside out.
Pretty much.
Because I was digging into their historical product mix, and the death of their old mobile monopoly is staggering. In 2023, their system on a chip, or SoC, product revenue was 50% auto and industrial, 40% mobile, and a measly 10% compute.
And keep in mind, compute is where the heavy AI lifting happens. 2 years ago is their absolute smallest slice of the pie.
Right. And by the end of 2025, that compute segment grew 90% year over year. It now makes up nearly 50% of all their SoC revenue. Compute went from an afterthought to the undisputed king of the castle in basically 24 months.
A massive shift.
But I want to understand why this matters so much for their profit margins. I mean, obviously, testing an AI chip is different from testing the chip inside my smartphone, but mechanically, why is it so much more lucrative for Teradyne?
Well, it all comes down to the brutal, unforgiving physics of complexity.
Okay, unpack that for me.
Let's think about the physical silicon inside an AI graphics processing unit, or GPU. A standard smartphone chip might have a few billion transistors. It's incredibly small, it's power efficient, and relatively simple to manufacture.
Right.
But a leading edge AI chip going into these massive data centers, that might have 100 billion transistors.
100 billion. And if even a fraction of a percent of those transistors are defective, the entire chip is garbage.
Absolute garbage. And it's garbage that costs tens of thousands of dollars to replace. So because these chips are so massive, testing them takes exponentially more time.
Right.
We are no longer talking about a fraction of a second per chip. We are talking about minutes. And to maintain output in a multi-billion-dollar semiconductor fabrication plant, you just can't afford to have chips bottlenecking at the testing station.
Right. Time is money.
Exactly. If the test takes longer, the manufacturer has no choice but to buy significantly more testing machines from Teradyne just to keep the assembly line moving.
That makes a lot of sense. I love to compare Teradyne to a wind tunnel for hypercars.
Well, that's a good one.
Because if you are building a cheap, reliable commuter car, you might do a few aerodynamic software simulations, build the car, and sell it.
Right. Doesn't need much.
Yeah. But if you are building a $3 million hypercar that goes 250 miles an hour, you have to put that physical vehicle into a highly specialized wind tunnel, simulate extreme theoretical stress, and make sure the chassis doesn't, disintegrate the second it hits top speed in the real world.
Right.
AI chips are the hypercars, and Teradyne is building the wind tunnels.
That's spot on.
Yeah.
And I'll actually take that analogy a step further. Imagine that hypercar requires a specialized, highly explosive fuel to run.
Okay.
AI chips draw an astronomical amount of electrical power. So during the testing phase, Teradyne literally has to pump kilowatts of electricity into the silicon to simulate maximum workload.
Right. I noticed the CEO mentioned their next generation instruments are in beta testing right now, and they're specifically designed to vastly increase the power delivery to these devices. I mean, my laptop overheats and the fans sound like a jet engine just from me opening a large Excel spreadsheet.
Right.
I cannot even fathom the thermal dynamics of pumping kilowatts of raw power into a piece of silicon the size of a coaster.
It's insane. The thermal management alone requires incredibly sophisticated engineering. I mean, if Teradyne's machine delivers the power incorrectly or fails to cool the chip during the test, they will instantly incinerate a chip worth more than most cars.
Wow.
And on top of that, the testers also require massive amounts of internal memory just to hold the insanely complex test patterns required to verify those 100 billion transistors. So the technical barrier to entry to build a machine like this is astronomically high, which is why Teradyne can command these massive premium margins.
Let's talk about memory for a second, actually, because the transcript also highlighted a massive shift in their memory testing division. They mentioned DRAM and flash memory. What is actually happening over there?
So we are seeing the exact same AI dynamic playing out in memory. Historically, let's say back in 2020, memory testing was roughly a 50-50 split between flash memory and DRAM.
Okay.
And just for context, flash is the storage memory that holds the photos and apps on your phone. DRAM is the active short-term working memory.
Right, the memory that actually feeds the processor while it's doing math.
Correct. So traditional processors only needed a moderate amount of working memory. But AI, large language models, they require oceans of memory, and they need it delivered at blistering speeds.
Right.
And this requirement births something called high bandwidth memory, or HBM.
Yes, I see HBM in every single semiconductor article right now. Break down the actual mechanics of why HBM is so difficult to test compared to normal memory.
Okay, so standard memory chips lay flat on a motherboard side by side. Data has to travel horizontally across the board to reach the processor.
Like houses in a suburb.
Exactly. But in the world of AI, that horizontal journey takes too long. So engineers started stacking DRAM chips directly on top of each other, vertically, like a skyscraper.
Wow.
They use microscopic lasers to drill holes through the silicon vias and connect the floors of the skyscraper with tiny copper pillars.
So you are minimizing the physical distance the data has to travel by stacking it straight up.
Yes, but think about the manufacturing nightmare that creates.
Oh, man.
You can't just build the whole skyscraper and test it at the end, because if the bottom floor is defective, you have to throw away the entire building.
Right.
You have to test every single bare die before you stack it. You have to test it after you stack it. You have to test the microscopic connections between the layers.
That sounds tedious.
It is. The chips are incredibly delicate, they're prone to warping from heat, and highly susceptible to microscopic defects. Because of this extreme complexity, DRAM and HBM combined comprise nearly 90% of the entire memory total addressable market in 2025. Flash memory is basically an afterthought now.
And total addressable market, or TAM, just meaning the total pool of money being spent on memory testing globally. So Teradyne is basically following the money right into the hardest engineering problem.
Exactly.
Speaking of hard problems, I saw a term in the transcript that I wanted you to clarify. They mentioned maintaining a 50% market share in something called VIP compute. What exactly is VIP compute?
Sure. So VIP compute essentially refers to custom ASICs, and ASIC stands for application-specific integrated circuit.
Meaning a chip designed to do exactly one job perfectly, rather than a general-purpose chip.
Exactly. Instead of buying an off-the-shelf GPU from NVIDIA, a massive cloud hyperscaler like Google, Meta, or Amazon might design their own custom silicon specifically tailored to run their proprietary algorithms in their own data centers. These custom chips are highly guarded secrets, and Teradyne owns half the market for testing them.
Wow. And it seems like they're expanding their reach beyond just the naked chip, too. They announced this new joint venture with a company called Multilane. From what I gather, it's focused on data center interconnect testing. Why is connecting these chips suddenly such a massive hurdle?
Because an AI chip sitting alone on a desk is completely useless. To train a massive AI model, you need tens of thousands of these chips working in perfect synchronization across a massive data center.
Right.
They are connected by copper cables and fiber optics. But when you start pushing terabytes of data across copper wires at these unimaginable speeds, you run into the laws of physics.
Signal degradation.
Massive signal degradation. The electrical signal gets distorted by electromagnetic interference, heat, distance. So the data arrives at the other end looking garbled.
That's a huge problem.
It is. Ensuring that the high-speed data networking between the server trays actually works is becoming just as critical and just as difficult as testing the processor itself.
Right.
So by partnering with Multilane, Teradyne is trying to own the entire testing ecosystem, from the raw silicon wafer all the way up to the fully assembled server rack.
Which is brilliant. And there was one anecdote in the call that I think perfectly illustrates this entire dynamic. The CEO was talking about their storage test division, and he mentioned almost casually that they are displacing an internal captive test setup for a new hard disk drive customer. What does captive test mean in this context?
Captive test means a company building their own testing equipment in-house.
Oh, I see.
Historically, if you were a massive tech titan, you had infinite resources. Right. You would look at your newly designed product and say, we know our proprietary architecture better than anyone on Earth. We aren't going to buy off-the-shelf testing machines. We will hire our own engineers and build our own custom testing rigs to save money.
Right, do it yourself. But the fact that Teradyne is winning business away from these captive programs means the tech giants are basically throwing in the towel.
They are completely surrendering to the complexity. The technology has become so unfathomably difficult that building a captive tester is now a fool's errand.
Yeah.
The tech giants realize they simply cannot keep up with the R&D required to build the testing machines while also trying to build the chips. It proves that Teradyne's commercial platforms are now fundamentally superior to what the richest companies on Earth can build for themselves.
Okay, I hear all of this. The physics are undeniable, right? But here's where it gets really interesting.
Okay.
If I'm sitting at home looking at my portfolio, a massive red flag is going up for me. For the last 5 years, investors have ruthlessly punished Teradyne for being a one-trick pony, overly reliant on a single major smartphone customer in Cupertino.
Right, Apple.
Now, they are completely dependent on a handful of hyperscalers buying AI data center equipment. So did they actually diversify their business, or did they just trade one dominant master for another?
See, it is the most vital question an investor can ask right now. Are you actually diversified or just highly concentrated in a new area?
Right.
And this brings us perfectly to how management is attempting to answer that question through their future guidance, specifically this brand new framework they are calling the Evergreen Target Model.
Yes. Management's guidance for the future on this call essentially took the old Wall Street playbook and just threw it straight into a wood chipper.
He really did.
But before we get to their grand futuristic vision, we have to look at what they're saying about tomorrow. Their guidance for the first quarter of 2026 is, frankly, eye-watering.
It is. They are projecting Q1 revenue between $1.15 billion and $1.25 billion.
That is an 11% sequential bump from their already massive Q4. And more importantly, it is a staggering 75% year-over-year growth compared to Q1 of 2025.
Why?
They are guiding EPS at $1.89 to $2.25. So if anyone was worried that the Q4 numbers were a one-off anomaly, this Q1 guidance is management forcefully stating that the gold rush is still accelerating.
Absolutely. And remember our discussion about the old smartphone calendar?
Yep.
Management made it explicitly clear that the old rules of seasonality are officially dead. In 2025, their sales roughly broke down to 40% in the first half of the year and 60% in the second half.
Right. Back half weighted.
Right. For 2026, they expect the exact inverse, 60% in the first half and 40% in the second half.
Which is wild. But the thing that really threw analysts for a loop was this new Evergreen Target Model. Usually a company like this gets on a call and says, here are our financial goals for the fiscal year 2028.
Right. They anchor their promises to a specific date on a calendar.
Exactly.
But CFO Michelle Turner introduced a totally different paradigm. Instead of anchoring to a year, they anchored their targets to the overall size of the market.
Right. They anchored it to the automated test equipment total addressable market, or the 8 TAM. 8 TAM. Got it. So in 2025, that overall global market for test equipment was roughly $9 billion. And Teradyne management essentially said, we aren't going to tell you exactly when this will happen, but when the overall global market grows to between $12 billion and $14 billion, here is what Teradyne's financials will look like.
And if they hit that scenario, what does the balance sheet actually look like?
It looks like an absolute cash printer. I mean, in a $12 to $14 billion market environment, Teradyne expects to hit $6 billion in annual revenue. That is double their 2025 levels.
Wow.
They expect to generate $9.50 to $11 in earnings per share, which is 2.5 times their 2025 EPS. And they expect to do all of this while maintaining massive 30 to 34% operating margins.
It's a bold claim. But if we connect this to the bigger picture, the reason they moved to this evergreen model, devoid of specific calendar dates, boils down to one word: lumpiness.
Lumpiness. Okay, explain that.
The AI infrastructure market right now is incredibly concentrated. The buyers are a tiny handful of hyperscalers. Think Meta, Microsoft, Google, Amazon. Right.
When they decide to build a new AI data center, they don't buy equipment smoothly over a 12-month period. They place a massive multi-hundred-million-dollar order for custom silicon all at once.
Right, because they have to secure the land, secure the massive power contracts from the local grid, build the cooling infrastructure, and then they order the chips and the servers.
Exactly. The orders are highly sporadic. They might order a massive batch of equipment, then spend 6 to 9 months physically installing it, writing software for it, and troubleshooting it before they even think about placing their next order.
Okay, that makes sense.
So because these orders are so massive and so erratic, Teradyne's revenue sloshes around across quarters.
Oh, I see.
A hyperscaler might delay an order by 3 weeks because a data center facility isn't finished pouring concrete. That single delay could push hundreds of millions of dollars from Q3 into Q4.
Wow.
And it completely ruins the traditional year-over-year growth metrics for that specific quarter, even though the fundamental demand for Teradyne's equipment hasn't changed by a single dollar. Okay, I understand the lumpiness argument, but if I'm a retail investor, I am spotting a massive, glaring contradiction in this transcript.
Oh, yeah?
Yeah. I'm listening to management pound the table, boasting about 75% year-over-year growth for Q1, promising a glorious $6 billion future. But then later in the Q&A session, an analyst pressed the CEO on overall growth for the back half of 2026.
I mean, what did Greg Smith say?
He admitted they are practically flying blind.
Wow.
I'm going to quote him directly here. We don't have great visibility into the second half, so we're a little bit cautious. We don't want people to sort of take the Q1 run rate and run with it for the full year. We expect that we're in kind of a 2-3-quarter surge that may lead to a shorter period of digestion afterwards.
That is a remarkably candid admission of near-term uncertainty.
It's terrifying if you hold the stock. Like, if I'm an investor, why shouldn't I hit the sell button right now? Are they just using this fancy, futuristic, evergreen model to mask the fact that they have extreme near-term uncertainty?
It's a fair point.
I mean, how on earth can I trust a multi-year $6 billion target if the CEO flat out admits he can't even see 6 months into the future?
Yeah.
Isn't evergreen just corporate speak for, we have absolutely no idea when this will happen, so please stop holding us to quarterly deadlines?
It's a very fair challenge. You are highlighting the tension between micro-visibility and macro-conviction.
Right.
You are entirely correct that Teradyne cannot see the precise timing of purchase orders in the second half of 2026. That is micro-visibility, and they lack it completely.
Right.
But their macro conviction is not based on hope. It is based on the undeniable physical laws and economics of artificial intelligence.
Okay.
They know the language models are getting exponentially larger. They know the chips required to run those models are getting unimaginably complex.
Yeah, we talked about that.
They know that complexity fundamentally requires more time in a testing machine. So they cannot tell you if a specific hyperscaler will sign a purchase order on August 15th or November 3rd, but they know with absolute mathematical certainty that the purchase order must be signed eventually if that hyperscaler wants to remain competitive in the AI arms race.
Ah, I see.
The evergreen model is management begging investors to look at the destination rather than agonizing over every pothole the car hits along the way.
I see the logic, but man, it demands an iron stomach from the investor.
Which brings us to the ultimate synthesis of this deep dive, the bottom line.
Let's do it.
We've digested the explosive Q4 revenue beat. We've analyzed the massive structural shift from mobile chips to highly complex AI silicon. We've torn apart management's highly confident yet incredibly timeline-vague evergreen guidance. So based on all of this data, what is the actionable takeaway for our listeners, bullish or bearish?
When you weigh the totality of the evidence in this transcript, we are taking a decidedly bullish stance on Teradyne.
Bullish. Okay. But that bullish rating comes with a massive, flashing warning sign regarding extreme quarterly volatility.
Yes. Bullish, but heavily medicated.
Exactly.
Let's break down the distinct catalysts that support the bull case. First up, and I think this was the most under-the-radar reveal in the entire Q&A session, is their entry into testing merchant GPUs.
This is critical, because earlier we talked extensively about Teradyne dominating the custom ASIC market for cloud providers.
Right.
But merchant GPUs are different. Those are the off-the-shelf, commercially available AI chips sold by companies like NVIDIA and AMD to absolutely anyone who wants to build an AI server.
Like mass market chips.
Exactly. And historically, Teradyne hasn't been the dominant player in testing those specific mass market GPUs.
But Greg Smith confirmed on this call that Teradyne is currently in production qualification to test merchant GPUs. I assume production qualification is exactly what it sounds like.
Oh, it is an agonizingly strict auditing process. The chipmaker brings in Teradyne's machine and runs it through months of relentless, grueling tests to prove it can handle the throughput and accuracy required for mass production without damaging the silicon.
And Smith expressed very high confidence they will pass it. He explicitly stated that they expect to start taking single-digit market share in this massive merchant GPU market by the second half of 2026.
Right.
And eventually, over the coming years, they are aggressively targeting a 30% duopoly share of that market.
If you're evaluating the stock, that is pure, unadulterated upside. I mean, it represents a massive expansion into a highly lucrative addressable market where Teradyne is currently generating practically zero revenue.
Right.
If they capture even a 10% share of testing the world's merchant GPUs, it has a substantial, highly profitable revenue stream that just isn't currently priced into their historical run rate.
Absolutely. The second bullish catalyst actually has nothing to do with chips at all. It's their robotics division. Because for years, Teradyne's robotics segment, which makes collaborative robot arms and autonomous mobile robots, or AMRs, it felt like an expensive, highly speculative science project strapped to the back of a deeply profitable semiconductor business. But the numbers suggest they are finally turning the corner.
They are officially aiming for break-even in 2026. And the key driver here is the application of physical AI in massive logistics operations.
Right. They specifically highlighted a massive e-commerce customer on the call.
Yes. Think about a modern Amazon-style fulfillment center. We are moving away from fixed robots bolted to the floor and moving toward AMRs, or robots that can dynamically navigate a warehouse, identify a specific bin, and transport it across the facility while avoiding humans and other robots.
Sounds like sci-fi.
It does. And the software complexity required to manage a fleet of 1,000 autonomous robots is staggering. Teradyne mentioned that this specific e-commerce customer's revenues with them are expected to roughly triple this year and grow substantially beyond that as these robots are deployed across their global facility network.
It proves that their strategic pivot to focus on giant enterprise accounts rather than selling one or two robots to small, fragmented mom-and-pop machine shops is actually paying off.
Big time.
So you have a booming AI custom silicon test business, a brand new revenue stream opening up in merchant GPUs, and a robotics division that is finally going to stop bleeding cash. That is a very compelling bull case. But we promised an objective analysis, which means we have to clearly present the bearish risks.
We do.
Why might a retail investor get burned holding this stock?
The primary risk, and it is a glaring vulnerability, is extreme customer concentration.
Okay, tell me about that.
Michelle Turner, the CFO, stated plainly that in 2025, they had two specifying customers that each accounted for more than 10% of total revenue, and one purchasing customer that accounted for more than 10% of revenue.
Right, and during the Q&A, they broke that down further. One specifying customer was in mobile, which is obviously Apple. One was in compute. And the purchasing customer, likely a massive foundry like TSMC, span both. So if you hold this stock, you are heavily reliant on the internal capital expenditure decisions of basically three massive global corporations.
Which ties right back to the lumpiness we talked about earlier. If just one of those hyperscalers decides to delay a major data center build out by 9 months because, interest rates are too high or they can't secure enough electricity from the grid, Teradyne's quarterly revenue will literally fall off a cliff.
And the stock price will take a severe beating.
Exactly. You are entirely exposed to the whims of a very small, very powerful group of decision makers.
The second bearish warning is for any investor who is looking at that 2021 all-time high revenue record and secretly hoping for a return to the glory days of the smartphone supercycle. Because if you are waiting for a mobile boom to bail you out, you are going to be severely disappointed.
So disappointed.
Management was brutally transparent about this. In their 12 to 14 billion evergreen TAM model, they explicitly state that the mobile testing market will likely only grow to about 1.5 times its current depressed size. It will not return to the previous peak.
No, it won't. And the reason why is a fascinating study in engineering efficiency.
Really?
Yeah. It isn't because smartphone chips are getting simpler. They are still incredibly complex. The issue is capital efficiency. Over the last decade, the massive smartphone chip makers have gotten ruthlessly smart about reusing their existing fleet of Teradyne testers.
They figured out how to squeeze more juice from the lemon.
Exactly. Rather than buying a brand new multi-million-dollar testing machine for every new generation of iPhone chip, they carefully manage their installed base. They optimize the software, they upgrade components, and they run the machines at maximum utilization year-round to avoid spending new capital.
Wow.
The tester fleet they already own is simply too efficient, which ironically caps Teradyne's ability to sell them new hardware.
It's the ultimate double-edged sword of building a durable, high-quality product. So if you are buying Teradyne today thinking it is a backdoor play on the next smartphone supercycle, you have fundamentally misunderstood their business model.
You are fighting the last war.
Exactly. So let's crystallize this. Here is the actionable takeaway for you, the retail investor tuning in today. If you are holding or considering buying Teradyne, you must treat this stock as a direct, undeniable proxy for AI complexity.
Perfectly said.
You are not betting on unit volume. You do not need the world to manufacture billions of new AI chips. You just need the chips that are currently being built to become harder, hotter, and vastly more difficult to manufacture.
Yes.
As long as silicon complexity escalates, Teradyne's services transition from a luxury to an existential necessity. It is a strong buy for the long-term AI infrastructure thesis. But you must be mentally prepared for wild, unpredictable quarter-to-quarter revenue swings.
You really do. You have to accept the reality that Q2 might look flat, Q3 might drop unexpectedly, and Q4 might explode to new all-time highs. You have to tune out the quarterly noise, ignore the day-to-day stock chart, and focus entirely on the evergreen reality of escalating computational complexity.
And that brings us to the end of our core analysis. But before we sign off, I want to leave you with a final, slightly provocative thought to mull over.
Okay, let's hear it.
Earlier, we spent a lot of time talking about Teradyne displacing internal captive testing for that hard disk drive customer. We noted that the tech giants are realizing they simply cannot build the testing equipment themselves anymore.
Right. The physics and engineering hurdles have become too high, even for trillion-dollar companies.
Right. So expand that idea to its logical conclusion. Think about what that implies for the entire global economy right now. We are watching sovereign nations and massive tech monopolies engage in a brutal, no-holds-barred war for AI supremacy.
Yeah, it's intense.
They are spending hundreds of billions of dollars securing land, building data centers, and designing custom silicon. But as these AI chips become unfathomably complex, as they draw more power, require more memory, and stack higher and higher, it seems entirely possible that the entire future of global AI development could eventually become totally bottlenecked by and completely reliant upon the duopoly of commercial testing companies.
Teradyne and their main rival, Advantest.
Exactly. If Teradyne and Advantest cannot build these ultra-sophisticated testing machines fast enough, or if the thermal physics problem of testing a kilowatt drawing chip becomes too difficult even for them to solve, the entire global AI gold rush grinds to an absolute halt.
That's true.
The hyperscalers can design the greatest chip in the world, but if they can't test it, they can't deploy it. The ones holding the testing equipment might secretly hold the ultimate bottleneck to global technological supremacy.
It's a profoundly sobering thought. I mean, the invisible ceiling of the artificial intelligence revolution isn't the software algorithms, and it isn't the raw silicon manufacturing. It might just be the physical machines required to ensure that the silicon doesn't melt when you turn it on.
It is definitely something to think about the next time you hear a tech CEO promise the moon regarding their new AI capabilities. Thank you for joining us on this deep dive into the true cost of complexity. We will see you next time.